Ladies and gentlemen, good evening. This is Christopher Aaron. I do thank you for tuning in. It's the 27th of September, 2017. And in this video, we will look at a topic I've had a lot of requests for, and that is what happens to gold and silver stocks in a general stock market crash. Now, we have looked at some fundamental data points over the last several weeks that show that the general stock markets around the world are vastly overvalued, whether we are talking about dividend yields, which are much closer to levels, for example, in the 1929 stock market crash, or whether we're talking about the total stock market valuation relative to GDP. This is also the second highest that has ever been, aside from the year 2000. So the point is, if you're watching this video and you're investing in gold, silver, and especially the gold stocks, what happens to those stocks during a general stock market crash? We're going to look at a few historic examples and take a look at the actual data. Now, the point of this channel is because I myself have seen throughout my career far too many times so much rhetoric in the precious metals markets. For example, and I'm not going to name the names, but I am going to pull up the publicly available articles that I have seen throughout the last number of years, consistently referencing things such as this: silver is going to skyrocket way above 100. Well, I do think one day it will be above 100, but also one day I will be dead. So the question is, which of these things are going to happen in a usable time frame for us as investors? Or we can take a look at articles such as this from 2014. The gold low has arrived at $1,281, $2,000 in 2014. And I just myself, throughout the years, I really became disgusted at the continuous portrayal of the price trajectories without any basis in the actual observable trends that are happening that you and I can monitor, that we can follow. We can see where large buyers are coming into these markets. We can see when trends are changing. And I do believe we are at one of those times presently. But we were not at one of those times several years ago when those articles were being posted. The point of this is to show you what is actually happening in the clearest way that I am capable of showing, which is the charts. So we are looking always every week at the short-term action here. This is spot gold to begin with, coming back into the region of the lows that I was expecting. If you go back from a couple of videos ago, I was looking at the 1283 to 1301 level. And I will tell you, if this breaks, it does not mean the end of the world. It just means that the advance that I am still expecting based on the breakout from the long-term downtrend is probably going to take the slower of the two paths that I was expecting. I do still think that long-term downtrend break that we saw 3 weeks ago is the single most relative technical data point to be concerned with in the gold market. So we see coming back right now, and I'll tell you, if there's one opportunity, I think, for people to get scared at just the wrong moment, it is now. And perhaps in the next couple days, if we dip below this ideal region that I was hoping for here in the 1283, I think this is the chance that people may get flushed out right before this next intermediate move sets up over the next 12 to 18 months. Silver coming back down into the mid-16s. Short-term action, we do not see any outperformance anymore from silver making a new low here, whereas gold did not make a new low. So that can tell me that the prices of both metals are headed lower over the short run. We will put everything into perspective on the longer term charts, the intermediate term charts next week. Nothing has changed that I want to bring to your attention on those charts. So I did want to focus on this topic, this really important topic And I understand that there's a lot of people who are only investing in the physical metals. I've made the case many times in the past that I myself invest in the physical metals, and I also invest in certain mining equities, gold and silver mining equities. And it's not that either is right or wrong. It's a question of risk tolerance, time horizon, your comfort level with the volatility, your ability to stay on top of these things and research these things. But in this video, we are going to look at some historical examples, because there are a lot of gold and silver mining and equity investors here. We're going to look at some of these examples of times in which the miners have behaved in a certain way when the US stock market has seen a crash over a number of years. So let's look at a couple of examples here. We're going to look at the two most recent examples of the US stock market and see what has happened with the stock market. Here's the S&P 500 on top. Now, if you can't see this very clearly, I encourage you to blow this up as big as possible, full screen, external monitor, and the best way that you can see this, because this is the largest that I can make this given the setup here on the video. S&P 500 on top, this is the US stock market, the 500 largest companies. Price of gold in the middle, and the HUI Gold Mining Index. This is an index of approximately 20 gold miners on the bottom. We are looking from the years 2000 through 2003. The peak of the stock market occurred right here in March of the year 2000, just above 1550 on the S&P 500. So we're going to do a very simple comparison and see what happened from the peak of the stock market to the bottom of the stock market. The bottom, in this case, coming at 775, a loss of 51% in the stock market in just a year and a half. What happened to these other asset classes over this exact time frame? We're not looking at any period before or after. Of course, it is important to put this into perspective, but we are going to focus strictly on the peak of the stock market to the bottom of the stock market. Gold in this time rose from $281 per ounce to $320 per ounce, a gain of 13%. And the HUI Gold Miners Index rose from 65 to 109 on the index, the average of all these gold mining companies. Good for a gain of 68%. So here we can see a very clear data point to show when the stock market crashes, it does not necessarily mean that the gold miners being components of stocks, these are stocks, but they are also gold stocks. So they are a mix between the first two. So we can see here very clearly that it is not always the case. There is a lot of fear mongering out there in the internet. There are a lot of people in the physical only camp who will tell you never to invest in the gold miners because if the stock market crashes, the gold miners are going to crash. This is not true. It's not true all the time. This is the key point. So let us look at another example. And I should add, we want to quantify all of these time periods here. So it's important to keep in mind what was happening with the S&P 500 at this time in the year 2000. The S&P 500 was at an all-time high. This was the end of a 20-year bull market, all-time high for U.S. stocks. Where was the price of gold? At a 20-year low. And where were the gold miners? Also at a 20-year low. So this is going to be important when we look at the next couple of slides, the reference, where were we in the broad scope of history when these moves happened? Okay, so moving to the next major example of a stock market crash, we are looking the S&P 500 from 2007 to 2009. This was the peak of the credit crisis, the housing bubble, which, mind you, was blown because the Federal Reserve lowered interest rates after the previous stock market collapse that we just saw. They lowered interest rates down to 1%. They held interest rates there for over 2 years, and they blew the next bubble. So what happened in this peak, the S&P 500 getting back to its previous all-time high? A year and a half later, the bottom coming here at the ominous figure of 666 on the stock market. The loss was 57% over a year and a half. What happened to the price of gold just over these dates? We're not taking into account what was going on in the last several years, which was a bull market here. We are just looking at the dates from the stock market peak in October of 2007 through the bottom in March. The price of gold gained 24% in this time. And here's the anomaly. Gold stocks in this instance did get dragged down with the broad stock market. Now, it's actually very interesting to take a look at what was happening here along the way. If you notice this first period here from late 2007 through March of 2008, the stock market was falling, gold was rising, and the gold stocks continued to rise. So gold stocks tend to hold up well when the price of gold is rising. They tend to follow the price of gold. But what happened here in the depths of the credit crisis crash, we're talking Lehman Brothers going under, we're talking Bear Stearns going over, Merrill Lynch going under, Citibank for all practical purposes going bankrupt if we're not for the bailout. I mean, basically every financial institution going bankrupt were it not for the bailouts. In the depth of that crisis, where we had Hank Paulson coming on the air and telling us that if we did not give him $750 billion to bail out his banks, that the end of the world was going to happen. Literally, it was going to be Armageddon straight out of the book of Revelation in the Bible or something like that. I mean, this was the sentiment at the time in 2008. It was unlike anything I've ever seen before. This is just to remind you of how bad things were then in 2008. In that time, gold, you can see what happened in the depth of the crisis here. Gold actually began to sell off. Why? Because it was the last asset standing leading up to the credit crisis, and people had to sell gold to pay margin calls for their other debts that were going under. So you had simultaneous selling here. You can see this, especially from the summer of 2008 into the end of the year, November, October, December. You can see that gold started to fall and the stock market started to fall. And if both of these things are falling, stocks and gold stocks are going to fall even more. So I think from peak to trough, gold stocks fell something like 85% in just 6 months. But we are looking at here from the stock market peak to the stock market bottom, a loss of 28%. So putting that into perspective, again, we had the stock market at an all-time high. We had gold very close to an all-time high at the start of this, close to its 1980 peak at $850 an ounce, so very close to that, practically speaking. And you had gold stocks at an all-time high for the time. Let's do a summary of all of these things across all these different time periods and then the present, so we can have some sort of an idea of perhaps what to expect if this kind of thing happens again. We looked at these two examples, and then we'll look at the present. 2000 to 2003, the stock market was at an all-time high. It fell 51%. Gold was at a 20-year low. It gained 13%. The gold miners were also at a 20-year low, gained 68%. 2007 through 2009, the S&P 500 was also at an all-time high. It fell even more, 57%. Gold was at an all-time high. It gained 24%. So a big difference here between gold at a 20-year low and gold at an all-time high. And then stocks, gold stocks, being at an all-time high, fell 28% versus gaining in the previous crash from a 20-year low. Where are we now? Stocks are once again at a new all-time high, even higher than the previous peaks. We don't know what sort of a crash or what sort of time horizon this will take, but this is the hard data. It is an all-time high. Gold is not at an all-time high, but it's not at a 20-year low. It's somewhere in the middle. It's 33% below its 2011 peak. But here is a very interesting data point. Gold miners, the gold stocks, are actually 68% from their 2011 peak. Much closer to the 20-year lows than an all-time high. So I think what we're seeing here is similar data across the S&P 500, all-time highs. We see examples of what gold does at different data points respectively. And the big piece of information here is the gold miners. 2000 to 2003, they were at 20-year lows. 2007, they were at all-time highs. They are much closer right now to all-time lows than all-time highs. So no one can ever say with 100% certainty what is going to happen this time. But the takeaway is that it's very important where the gold miners are in the relative cycle compared to what is happening in the broad stock market. We see the stock market at an all-time high. We see the gold miners much closer to all-time lows than all-time highs. That is really important for what may happen here going forward. Let's look at one other example. Homestake mining. This is really interesting, a historical look courtesy of the Long Wave Group. We are looking at the period from the great crash of 1929 in the stock market, where the stock market fell by 90%. Greatest decline in the stock market in the United States of all time in nominal terms. 90% decline. Now, there was not an HUI index back then of gold stocks. There was, however, one very well known, the largest gold miner of the company called Homestake Mining. This is the largest miner in the United States at that time. And what happened from the peak of the stock market through the crash, we can see from the level right here of approximately 80 on the index, we can see a rise through 300. So over a 200% increase. Of course, this occurring during a time when the United States was on a gold standard. But the really interesting thing to look at here is that this rise in the value of Homestake mining, right? A big part of this rise happened before the price of gold was officially raised by President Roosevelt, right? This happened right here in 1933. A big part of the gain in the gold stocks had occurred before that. Why is that? Because quite often the gold miners tend to be forward-looking vehicles, and they predict what is going to happen to the price of gold. So this is something that we use quite often in the premium service that I provide, which comes out every week. We are quite often looking at the ratio of the gold miners to the price of gold itself for those types of early warning signals. They're not right 100% of the time, but it's certainly better than flying blind with none of the data. We also cover the physical gold and physical silver markets for premium subscribers, as well as the individual miners that we are investing in here and all the research to back that up. If you're interested, you can find more about that on the homepage. The link to that is below. If you're an individual, you're new to the precious metals, or you're looking at changing around your portfolio, perhaps looking at getting into the miners for the first time or switching up your holdings, I do work with individuals on a one-on-one basis by phone and by email. So again, this comes from someone who, myself, I have been rather disgusted by what I see in this industry over the last 15 years. I don't like the fear-mongering. I don't like the attempts to scare everyone that things are going to skyrocket today or tomorrow. I do think that the metals are putting in important lows in this time period right now. Of course, prices can go a little bit lower, but I do think that these lows that are setting up are going to be more similar to the 2000, 2001 lows across the precious metals. In other words, a really nice base from which a multi-year bull market can unfold. But I do not like that type of rhetoric that I see in so many other places in the precious metals community. So I do thank you for tuning in. The point here is just to keep it as real as I am capable. I welcome your comments. I do try to answer some of the comments. I like to hear if you find this type of analysis useful or not, and for whatever reason. So thank you. Have a great rest of the week. Watch for some important lows coming in here. We'll update the gold chart next week. But I think this type of data is very important to keep in mind if you're a gold stock investor, what the range of possibilities is for the miners, and the fact that the valuations on the miners are much closer to all-time lows at present than all-time highs. And that was the big difference between that 2000 period and the 2007-2008 period.